Before we jump into the fun stuff, there is a few boring disclaimer, risk disclosure things I have to go through. First and foremost, general advice warning. All of the information provided in this webinar is general in nature only. It does not pertain to any one person's particular financial situation. Number two, please don't make any investment decision based solely on the contents of this webinar. It should be used in conjunction with your own research and consultation with your financial advisor. And last but not least, of course, as I'm sure we all know, trading in equities is risky. Past performance is no guarantee of future return. All right, now that boring stuff is out of the way, let's get straight into it. First and foremost, I want to take some time to define exactly what a market cycle is. A market cycle is a phenomenon that occurs in almost all market or business sectors, wherein prices and consumer sentiment follow a predictable and cyclical, hence market cycle, trend. Generally speaking, there's 4 stages in a market cycle. The first of which is the expansion. This is characterized by rapidly increasing price growth and high levels of investor and consumer optimism. During this time, individuals and businesses' wealth will grow rapidly, and they're more likely to take on debt in order to enhance this growth. Rising prices make investments profitable, which motivates more investing, further pushing up prices in a virtuous cycle. In equities, this is often referred to as a bull market. The next phase is the peak. This is characterized by a plateau in the price growth and a stabilization in sentiment levels. During this time, the wealth effect that has encouraged businesses and consumers to take on debts begins to dissipate, and excessive debts or poor investments that were made possibly during the height of the expansion begin to be liquidated or paid back. Then we have the recession, characterized by rapidly falling prices. During this time, investors and consumers become increasingly pessimistic. Prices fall, making investments unprofitable, which further encourages selling, which in turn further decreases prices. This is a vicious cycle. Bad debts are rampant, and capital losses or defaults are widespread as deleveraging takes place. In equities, this is often referred to as a bear market. And lastly, we have the trough. Prices once more stabilize as pessimism peaks. Selling is exhausted, and gradually buyers return to the market, enticed by now heavily discounted prices. As the buying begins, prices begin to rise, sentiment picks up, momentum increases, and we return to the expansion phase as the cycle begins anew. The image on your screen is a very basic representation of an equity market cycle. The average length you can see is shown there. It's worth noting that the long-term trend of the market, given by that 45-degree line, is upward. So remember that time is an investor's best friend. Right, so we have an idea of what a market cycle actually is, but why does it matter for equity investments? Well, I would argue that market cycles and the ability to time them can be hugely impactful on the successfulness or lack thereof of any equity market investment. The chart on your screen is of the S&P 500 index over the past 20 or so years, from 1999 to today. As you can see, the performance of the index does somewhat resemble this market cycle model we saw on the last slide. Now, let's have a look at some numbers. You can see here the unfortunate investor who entered the market at the peak of the dot-com boom in May of 2000 would have lost 49% of their money by the time the market bottomed 2.5 odd years later in October of 2002. That same poor investor who has entered the market in the peak of the bull market in October of 2007 would have lost 57% of their money by the time the market bottomed 18 months later in February of 2009. GFC was obviously a particularly nasty market pullback. However, the savvy investor who entered at the bottom in October of 2002 made 101% return on their investment by October of 2007, And the gentleman or lady who entered the market at the bottom of February '09 made 333% profit by the time the market reached its current peak in September of 2018. And of course, there is a very good chance that there will be a new peak very soon. Finally, let's look at some peak to peak. The investor who went long at the height of the dot-com bubble would have made a mere 2% by the height of the pre-GFC build-up in October of '07. And the investor who went long in October of '07, who held his position all the way down through the GFC, clearly has nerves of steel, and all the way back up until September of '18, would have made 87% in 10 years. So a healthy gain, but not even 1/3, in fact, closer to 1/4 of the profit he would have made had he entered the market 18 odd months later. It would be the difference between turning an initial, say, $100,000 investment into $187,000 or $433,000. I certainly know which one I would choose. So hopefully that sort of cleared things up. Quite obvious that even relatively small differences in timings, 6 months, 12 months here or there, can make huge differences in the success of equity market investing. Now, of course, the examples I've given are only the two most recent. History is rife with equity market booms and busts. In the US alone, equity markets have fallen over 20% and often over 40% on no fewer than 29 different occasions since the New York Stock Exchange was founded back in 1792. That's an average of once every 8 or so years. So, now that we know why it's important, let's answer the really important question: where are we now? As with all of investing, it is a hell of a lot easier to answer these sort of questions in hindsight. In hindsight, it's clear to us that the excessive optimism we saw in 2000 and 2007 were market peaks. However, at the time, very few investors, institutional, retail, or otherwise, were able to correctly predict that they were in fact at the peak. However, some people did see those periods for what they were and reacted accordingly. So what matrix and what metrics did they use to determine whether or not they were at a peak or just in the middle of a bull market run? There is, of course, no one signal that you can use with 100% accuracy to predict an impending bear market or recession, but history has given us a few indicators that have a pretty strong correlation. The first of which, and probably the most widely known, is the yield curve. The yield curve, for those of you who don't know, plots the yield on maturities. In this instance, when people refer to the yield curve, they usually talk about the US government bonds or US treasuries. It plots the yields of different treasury bonds over different maturities. So under normal conditions, the yield curve slopes upward over time. That is to say that longer term or longer maturity bonds will yield more on a per annum basis than shorter maturity bonds. This is because investors do expect to be compensated for locking their money away for a longer period of time. However, that is not always the case. In times when the short-term economic outlook might be relatively strong, but the medium to longer term outlook is unclear or perhaps quite weak, the yield curve may flatten or even invert completely. A flattened yield curve occurs when short-term yields are the same or at least very, very similar to longer-term yields. And an inverted yield curve, which is what we're really interested in here, occurs when short-term yields are in fact higher than the longer-term counterparts. The chart you've got on your screen there is compiled by Brower and Janikowski, two US economists, and they've plotted the yield on the 10-year government bond or the 10-year treasury, less the yield on the 3-year government bond. So that black line down the middle, you can see it says 0 BPS, 0 basis points. That would be exactly flat. That means that the 3-year treasury is yielding the exact same as the 10-year treasury. Anything above that would indicate that the 10-year Treasury is yielding more, and anything below that would indicate that the 10-year Treasury is yielding less. If we look back through history, you'll notice, and the other thing to note is in this chart, the gray, shaded gray sections, hopefully you can see that, horizontal, vertical sections that are shaded gray represent US market recessions. So we can see that almost every time that blue line has fallen below zero, that is to say the yield curve has inverted, we have been granted a recession, usually 1 to 2 years afterwards. So right now, at the time of them compiling this, the difference between the 10-year and the 3-year Treasury was about 20 basis points. Today, as of this morning, it's about 17 basis points, so pretty much the same. It got as low as about 15 basis points last December. So certainly the yield curve is looking pretty flat at the moment. But it is most certainly not inverted. And in the past, yield curves, we can look in the sort of mid-90s, for instance, have stayed flat or just above flat for extended periods of time before finally inverting. It could well be that the yield curve won't invert for another year, another 2 years, possibly even longer. And the other important thing to note is that when it does invert, that is not a signal that the GFC has started. That is not a signal that the S&P 500 will lose 20% of its value the next day. Generally, the yield curve inverts a good 6 to 18 months before the recession really begins in earnest. So even if the yield curve inverted tonight, you'd still have 6 to 18 months of consolidation based on past performance before any recession really began. Now, while the yield curve is the most well-known, it's not the most basic. The yield curve really is a derivation by the US bond market of more fundamental data. These are economic indicators, specifically leading economic indicators. So one of the best analysts of economic data in the world is the Conference Board. This is a global non-for-profit research organization founded and based in the US, but they do research all over the world. It's been releasing its leading economic index since 1960. This is very easily available for anyone, but surprisingly, not a lot of people know about it. So I would highly advise, if you're interested, just Google Conference Board Leading Economic Index when you have a chance. Really fascinating stuff. This index that they release every quarter is comprised of 10 indicators, including weekly manufacturing hours, weekly unemployment claims, manufacturers' new orders, building permits, stock prices, credit availability, interest rate spreads, and consumer expectation for business conditions. So on the chart here, you will see that the LEI index has, similar to the yield curve, fairly accurately predicted recessions. Again, the shaded gray areas highlight recessions, and that blue line has almost without fail dipped prior to market entering a recession. You can see at the moment, it looks like it's going in a pretty strong uptrend. Now, obviously, this is over a sort of 50-odd year period. If we zoom in on the past 5 years, the LEI index has been flattening, particularly in the past year or so. It hasn't done a whole lot. In fact, it's only increased by 1/2 of 1 point in the past 6 months. Again, this is in the US. But it's at a high level. The standard level is 100, which is standardized in 2016. It's currently at 111.5, and it hasn't even really begun to fall at all. So peaking, perhaps, but certainly at a very high level, not showing any clear signs of a recession in the near future, but worth keeping an eye on. Next, we have GDP. Very simple, very basic measure, but a very reliable one nonetheless. This is quarterly GDP figures that you've got on your screen for the past few years. You'll notice that since the start of 2017, GDP has been increasing on a per quarter basis very consistently. It reached 3.1% year on year in Q4 of 2018, which is its highest growth rate in about 3 years there. Now, the growth is largely debt financed in the States, but there is certainly a lot of broad-based strength in the economy. Unemployment is at 3.7% as of the most recent reading, which is a 48-year low. And consistent upward growth in GDP is always a positive sign for any economy. So, lastly, let's have a look at stocks. Pictured, we have the S&P 500 index over the past 10 years. So the start of that chart is pretty much the bottom of the GFC in early 2009. And the end of that chart was last night's session, 16th of April, 2019. The commonly accepted, albeit somewhat arbitrary, definition of a bull market is 20% off the lows without falling 20% off its recent high. At the close of trading on the 22nd of August 2018, US equities had been in a bull market for 3,453 days, which makes it officially the longest bull market in US equity history. Surpassing the previous record, which was from the late 90s to the early 2000s, the mid 90s to the early 2000s. However, we did see a bit of volatility in Q4 of 2018, as I'm sure many of you will remember. The S&P 500 lost 19.8% in basically one quarter, the majority of which it lost in 1 month alone. I think about 15% of the 19% loss, or nearly 20% loss, happened in the span of 2.5 weeks in early December. So pretty extreme pullback. Now, if we take the, again, somewhat arbitrary definition that an index or an asset needs to fall by 20% or more to end its bull run, then the S&P 500 is still technically in a bull market. And you can see on the right-hand side of the screen a pretty aggressive V-shaped recovery, bouncing off its lows in one of the best up days since the GFC. In fact, I think the best up day since the GFC on the 26th of December, Boxing Day, and rallying almost back to all-time highs. I believe the all-time high is about 29.30. For the S&P 500, we closed last night at 29.07. Now, the Dow Jones, which is another measure of the US stock market, and the NASDAQ, which, as many of you know, is a slightly more volatile version, tech-centric or tech-based US index, did technically end their bull market runs, falling over 20%. Last quarter, or in quarter 4 of 2018, S&P managed to avoid that. Again, relatively arbitrary, but still interesting that it only fell 19.8. Combine that with the strength and speed of the recovery in all three indices. Obviously, the S&P 500 is the only one pictured here, but the Dow and the NASDAQ have rallied very similarly. And it doesn't seem to me, at least, that this pullback in last quarter was anything more than a fairly aggressive market correction, but a standard correction nonetheless, the likes of which we've seen in 2014, 2016, 2011, and I'm sure we will see again. So we've considered the data, the yield curve, GDP, leading economic indicators, and of course the price action of equities. Can we make a prediction about where we are on the cycle currently? I think we can, and I would say we are right here. The end of the current expansion phase of the market cycle. So I don't think it has ended. Again, the speed of the recovery in last quarter leads me to believe that there is a bit of life left in this Granted, very old bull, longest bull market in US equity history, but there is still room to move there. I predict, or I expect, that in the next 12 to 24 months, the bull market will probably end. It's not obvious what that ending will look like, but I suspect that it will stop gaining, at least stop gaining considerably, and start entering a period of consolidation we know as the peak. So that'll last for another sort of 6 to 18 months, as pictured there, before beginning a bear market or recession at some stage between late 2021 and I'd say late 2023. Of course, this is subject to change as new data becomes available, and it becomes available every day. But as of right now, this is the picture as I see it. There is a little bit of life left, but not a whole lot. And now would be the time to start considering investment plans above and beyond long-term hold. So what do we do in this environment? I would argue it's probably too late to add long exposure to stocks, certainly too late to heavily add long exposure. Situational buying of discounted opportunities could certainly see great returns, as it always can, but I would argue that these opportunities are pretty few and far between. Most valuations seem pretty full. In fact, I would argue quite a few valuations seem quite stretched. I'm particularly sort of apprehensive about some of these tech companies. Just sort of anecdotally, we saw Lyft, which is the most recent quote-unquote unicorn to list on the NASDAQ, a tech unicorn, which is, of course, a company that lists with a market cap of over $1 billion US. Saw that list a few weeks ago. The stock is down well over 30% in its first few weeks of trading. So I would argue that valuations are pretty full and people are starting to clue on. So I wouldn't be desperate to run out and buy any NASDAQ ETFs at this level. However, with all that said, I think it's probably also too soon to begin really moving considerable parts of your portfolio to cash or even taking a short position on the market. I don't think there's going to be a lot of downside for at least the next 3 years, 2.5, 3 years. And if you are moving to cash, as I'm sure we all know, risk-free rates are so low at the moment that sticking it in a savings account is barely going to cover inflation. Not really practical for people like you and I who would like to generate a return on our capital. So what do you do? Fortunately, I believe that there are some directionally neutral strategies that thrive in medium volatility environments, which is exactly what I think is likely in this sort of topping motion that I expect to see in the coming 3 to 5 years. These strategies are based around options. One such strategy that a lot of people know is the covered call. Covered calls are a great entry-level option strategy. I'm a big fan, and they allow for healthy increases in returns in otherwise very flat markets. Strategy is quite simple. It simply involves selling one call option for every 100 shares of underlying stock you hold. For selling an option, in this case the call option, you receive money upfront, known as the premium. If the stock stays flat or falls, the call option will expire worthless to the purchaser, which is good for you because you get to keep the premium and you don't have to do anything else. If the stock rises above this previously agreed upon price, this is known as the option's strike price, you will be required to sell your shares to the purchaser of the call option. So that is your risk, is your upside in a covered call strategy is limited. However, that might not be a huge risk if we're seeing a sideways trading market. It's possibly not all that likely that we will see a lot of big moves to the upside. You could argue that your upside is already capped. And certainly if you were obliged to sell your stock, you could quite possibly just buy the stock back at a lower price once it comes back down. So there's a bit of academic research about covered calls. As I mentioned, it's not a new idea by any means. Sydney University, most notably, commissioned by the ASX back in 2012, conducted a report titled An Encyclopedia of Australia Buy-Right Returns. Buy-Right is just another name for a covered call strategy. And they concluded that during periods of flat or declining stock returns, option strategies can be implemented to protect the investor against downside risk while improving performance. It's a bit fluffy, but basically saying these strategies are very good if stocks aren't going up in a sort of 45-degree line. And possibly more interesting, really, a buy-right strategy generates a higher risk-adjusted return relative to a long-only stock portfolio. And that isn't just in sideways trading markets, that is always. Obviously, you need to be smart about how you do it, and it's a little bit harder in upwards trending markets, but certainly in sideways trading markets. Higher risk-adjusted return. So that basically means that for a set level of risk, this covered call strategy will generate higher return, or conversely, for the same level of return, you will take on less risk employing a covered call strategy. So I'm a big fan of covered calls, and I would urge any of you who think this might be a good idea to do a bit of your own research or get in touch with me afterwards to discuss further. However, I will say upfront that there are some downsides, the most notable of which is a covered call strategy is quite capital intensive. For obvious reasons, you'll need to own at least 100 shares of an optionable stock in order to do this strategy. Now, we're focused mainly on the US, but there's no reason why you can't do this strategy in Australia as well. Covered calls are very common on your bank shares, for instance. You own shares of CBA, the stock price doesn't really do a whole lot for 5 years, but you pick up the dividend. That's a great way of investing. It could be even better if you sold some calls on CBA as well. Just a thought. But again, it is quite capital intensive. There is another strategy that I like even more that is less capital intensive and can generate an even higher return, and this is the put right. As the name suggests, it involves selling puts rather than calls. The necessary capital outlay for this strategy is going to be considerably lower, and because you don't need to own shares in the underlying. And generally speaking, put options are considerably more expensive than call options. And that is very good if you're selling them because you get to sell something much more expensive. Just an example, a put option on S&P 500 futures that expires in 1 week and is 100 points out of the money, that's 100 index points out of the money, is 11 times more expensive than its corresponding call option. So you will make 11 times more return in this particular example by selling puts than by selling calls. And that's a big part of the reason why I'm a fan of selling puts. Now, this strategy, the put right, is about as close to directionally neutral as you can get. Rather than trying to predict where the market will go next, which is very hard to do at the best of times and certainly even harder in a peaking market, all you have to do is try and predict where the market will not go in the next week. So that's going to greatly improve your probability of success. You can see my little illustration on the screen there. If we were to sell that aforementioned 1 week put, that's 100 points out of the money on S&P 500 futures, the black arrows represent a market movement that would result in you, the put seller or the put writer, generating 100% profit. That is to say, you receive all the premium for selling that put, and you have sold, the purchaser has that put which expires worthless in a week's time. The red line is a movement that you would get in a bit of trouble with. You can see it would have to be a pretty extreme and pretty fast downward movement. Capital 19 has been running a strategy based on put writing. In fact, we call it the weekly income strategy. It's been running since about 2012, and again, it involves selling these out-of-the-money put option spreads on the S&P 500 index. And now the word spread is very important there. For any of you who know quite a lot about put selling, or who have figured it out, if you are selling options naked, selling call options naked, and you're not if you're doing a covered call, hence the word covered, but if you were to sell call options naked, your downside risk is unlimited because the upside of the stock is unlimited. If you're selling puts naked, your downside risk is not quite unlimited, but pretty close to it. In theory, a stock can go to zero. If you sell a spread, that means that you buy a put below the put that you have sold, and it caps your risk. It just stops you from being in a situation where your downside is unlimited. Now, we've been running this strategy, as I've mentioned, for about 6 years now, and it has been largely very successful. You can see 95% of our trades have been winners, and it's been generating returns of up to 15% per annum, and in fact, sometimes quite a bit higher than that. The reason I like this version of put writing rather than any other is the asset that we're writing the puts on. Obviously, the S&P 500 is an index. It is probably the most diversified index in the world. So there is no stock-specific risk when selling this put. If you were unfortunate enough to sell a put on, let's say, Boeing, for instance, a few months ago, you would have gotten yourself in a bit of hot water when a plane fell out of the sky. If you're selling puts on the S&P 500, that is not something you need to worry about. There is no way that any one adverse force majeure can affect your investment. That's why diversification is the first thing they teach you. It's also incredibly liquid. The ES, we actually trade the S&P 500 futures. The instrument we trade is called the ES, it stands for E-mini future, is probably the most liquid, or certainly one of the most liquid equity market assets in the world. So there's going to be virtually no execution risk. You can get your order filled pretty much any trading day at any trading time. As I've mentioned, we sell spreads, so our downside risk is capped. In the event of a black swan movement, we've never sold naked puts, or we don't sell naked puts, and we don't advise anyone to do so. And the short-datedness of this strategy means that there is going to be lower risk. Again, we sell puts with roughly a week until expiry, which means that we would have to see a pretty extreme movement in the underlying asset pretty quickly in order for us to get in trouble. And in fact, we can look at this probabilistically. The probability of any one trade, and this is based off deltas for any of you who are option whizzes out there. For those of you who aren't, just take our word for it. The probability of any one trade that we place being a loss is between 2 and 5%. And you'll see on your screen there, 95% successful trade. So that lines up. So very low risk. If we do one of these a week, then we expect 1 or 2 trades a year to be losers, and the remaining 50 odd will be winners. The last point, and probably the most exciting about this strategy is how to handle the losers. So we will have trades, and we do have trades that are losers. We trade once a week to approximately a year are losing trades. Now, the reason that I like this strategy so much is if there is a losing trade, that necessarily means the market has fallen hard and fast. Now, and if the market's fallen hard and fast, that means that volatility, which is measured by a thing called the VIX index, has increased pretty dramatically. Volatility is one of the main components in option prices. So that means that if the market has fallen, then the value of the options that we sell has increased dramatically. So while we may take a loss on the current position, we can very quickly recoup those losses by selling the now considerably more expensive puts in the following few weeks or even months, depending on how long the volatility hangs around. So we do trade fully expecting to have a few losses and also fully expecting to compensate for them quite quickly afterwards. I think that's got a nice sort of symmetry about it. And it makes things fairly mechanical. I mean, one of the hardest things to do when there is an adverse movement, which there always is in equities, there always will be, one of the hardest things to do is to simply know what to do. With this strategy, the best answer almost always is just keep doing what you're doing, and it'll handle itself. In 2019, we have yet to have a losing trade. So it's been going very well for us in the first sort of 3 months of this year, or 4 months now. So I'll do a quick recap here. US equity markets, in my view, are coming to the end of their current expansion phase or bull market. I would suggest 3 to 5 years before we enter the next recession in earnest. In my view, it's too late in the cycle to be adding much long stock exposure. I think we're going to see a fair bit of sideways trading, but it's also probably too early to be moving to cash, particularly with risk-free rates so low. So I would propose that directionally neutral option strategies are optimal, pun intended. Covered calls, or my personal favorite, the put right. If you're interested in the put right strategy, we do run the weekly income strategy, have been running it for many years now, and are quite big fans of it. All right, so that just about covers the bulk of the content for this webinar. In the interest of keeping things moving, I'll get straight into questions. If for whatever reason your question isn't answered in this webinar, then please do send your query to wis@capital19.com and I will get back to you as soon as I can. All right, let's take a few questions here. So we have a question here from Mike. Yep, selling options in Australia as well as the US. So I did touch on that back when I was talking about the covered calls. You absolutely can. Through Capital 19, we have a multi-currency platform and a multi-market platform. So options can be bought or sold, as I recommend, in both Australian markets and US markets in exactly the same way. The function is exactly the same. And you can also, if you're feeling brave, venture forth into other markets as well. Europe, parts of China through Hong Kong are optionable. Yeah, you can do your FTSE in the UK, CAC, DAX, all that good stuff. Any other questions? Okay, got one here from Tim. He's asking about the currency. So this is a good question. Obviously, we all live here in Australia. What are the risks of investing in the US? Obviously, there's going to be a currency difference and a time zone difference. Great question, Tim. So you can trade through our platform, US and indeed European or any international market. You can trade any international asset using your Australian dollars through our account. So it is a multi-currency platform. The conversion fee on any currency, I would argue, is very competitive. It's certainly the best rates that I've really seen anywhere. It's going to be a lot better than if you converted the funds manually yourself. So there is pretty low cost to converting your currency. And the risk is, again, fairly negligible there. This weekly income strategy in particular is run by our advisors, so there are going to be at least 2 sets of eyes and probably more on every US overnight session. So if you are the type of person who likes sleeping, which I assume you all are, and you don't want to have to stay up and watch the US market all night, that is exactly why we are here. I've got a question from Don. What is the minimum amount you can invest? And Don and Rudolph have both asked, what are the fees? So fees can be found on our website, and if you gentlemen would like to flick me an email afterwards, I can send you a link to the website. But very simply, it is $15 US for a stock or an option minimum, and 2 cents per share in the US, and $15 Australian for Australian stock and options with a 0.15% trade value going above that. So the fees, I would argue, are very competitive. If you do the weekly income strategy, fees might even be a little bit lower. So do get in touch on weekly income strategy or WIS at Capital 19 to learn more. The other thing I should mention on fees is for any account and any trade that you place, be it an option trade, a stock trade, to do with our managed WIS or not, the fee is going to be the same regardless of whether or not we place the trade or you place the trade yourself. So we don't charge any extra for phone in, we don't charge any extra for emailing in, which I think is a pretty nice advantage there. So if you wanted to place a trade, you could call up your advisor. You will have an advisor. And when you come on board, call them up and say, hi, Elliot, hi, James, hi, Tim, whoever it may be. This evening, when the US market's open, I would like to buy XYZ share, or I'd like to sell XYZ put, or whatever it may be. And we can get that placed for you at no extra cost. There's also no hidden fees. So there's no account management fee, there's no account opening fee, there's no ongoing fees of any kind. All of the fees are charged purely on a per transaction basis. And again, the full outline of all the fees for all the assets can be found on our website, www.capital19.com. Any more questions? How do I get a broker to handle my shares? So another question from Rudolph. So if you opened up an account, you can fund with, as I've mentioned, it's a multi-currency platform. So you can fund with Australian dollars, you could fund with US dollars, you could fund with pounds, shekels, Israeli shekels, francs, really euros, just about any major currency you can think of, yen. The account could be funded with. You can also do what is called a position transfer. So if you have an existing stock portfolio with a ComSec or a NAB trade or whatever it may be, you could absolutely transfer that across to us, and we would be able to manage that for you. And again, there is no management fee, ongoing management fee. There's no additional cost for calling in a trade or emailing in a trade. So you can do it yourself or you can get us to do it. It is exactly the same to you cost-wise. Any other questions? No. Fees and charges has come up a lot. Yeah, hopefully I've sort of answered the fees and charges there. I might end it here because it is getting on in the evening and we all have things to go and do, but I'll leave you with a big thank you for joining me. And if for whatever reason your email wasn't answered or you'd like some further information, please do get in touch. I can be reached at wis@capital19.com. I will endeavor to answer all questions as quickly as possible. Aside from that, thank you so much for joining me and have a great evening.